Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
And I'm Simon.
We're all property people running our own businesses, and this podcast is just us chatting every week about the reality of anything and everything property. This week, we are very pleased to be joined by Simon Glastonbury, our resident mortgage expert. And as much as we like talking to Simon, we had planned not to be talking to Simon for a little bit longer than this. However, after our last recording with Simon, one or two things changed, and slightly unexpectedly, and perhaps a little more dramatically than would normally be expected. But before we get into that, I'm just going to let you know that at the end of this episode, we're going to run through some current mortgage rates. I might sort of say best, but I'm not sure we can actually attach best or good or anything positive, yes, to the current mortgage rates. But we will run through some typical mortgage rates at the end of the episode, so hang on for that. In the meantime, though, I'm going to hand over to Simon to just initially give us a bit of a summary of the ups and downs and turmoil and adventures of the last month or so since we last spoke.
Good day, guys. It's adventures certainly over the last few weeks, certainly from mortgage broking point of view. Rates being withdrawn very, very quickly. Lenders panicking, I would say, because they're not quite sure what's going to be happening with rates over the coming years. And for those who've kept rates and products on the market, they've increased them at a rate we haven't seen for a very long time.
When you started to see this happen, how rapid was it? I mean, after the mini budget, obviously, was it on that day, or did you start seeing things sort of a few days later, and how quickly did it snowball?
Days. When the products get withdrawn from lenders on, depending on which lender, they can sometimes say, we're withdrawing them as of close of business, or some of the lenders were quite good and then would give you until 10, 11 o'clock of that evening to get applications through. I'd say that's good because at least it does give you time to contact clients and say, do you want to go ahead? Do you want to get the products in? Because as soon as the application, for most of the lenders, as soon as the application's in, you've secured the rate if the application goes through to offer. As we know, lots of things can happen in that time, which will dictate whether you get the offer or not. But if it goes according to plan, you will get that product, so it's secured. So people were putting lots and lots of products in. And then, of course, you have a situation where systems are crashing because so many applications are going in. Most of the sort of high street, as people would know, the high street lenders, they were the ones withdrawing very quickly. And then, although saying that, the specialist lenders, buy-to-let lenders, HMO, etc., they would, generally speaking, give you a little bit longer. But then once the products were withdrawn, you basically didn't see products coming back on the market. Since that, I mean, it's been a crazy, 3 weeks, possibly, since we last spoke. And since that, pretty much all of the lenders have come back on board. But let's just say the rates are interesting.
Are there still fewer products on the market, though? If all of the lenders are sort of back in the market in some degree, have they come back with fewer products, or is the product range there again as well?
Yeah, product range is still there. They're definitely fewer on the market. There are a couple of the smaller lenders and withdrawn completely from the marketplace. So, and that, I think that's short term, definitely, until they get their house in order and they know that they're more confident as to what's going to happen. How they can be more confident, we don't know. But I think that's the case. But the lenders are definitely coming in, but you can see the more nervous lenders are coming back with rates which are much higher. So whether they're also controlling that with levels of business, we spoke some time ago about service. The lenders were pulling rates quite quickly to manage service. It's not what they were saying directly, but you could see it without a doubt. They had far too many applications in. They couldn't control it. They couldn't get the admin through and underwrite them, which is frustrating from our side, from your side, putting the applications in. So they were controlling it that way. And now they seem to be controlling, certainly from a service point of view and a rate point of view, because they don't know where they're going with rates either. It's very clear. You look from the outside, looking in, that's exactly what they're doing. But it seems to be affecting the smaller specialist lenders more so.
So we'll talk more about rates sort of later-ish in the podcast. We'll save the exciting bit. But there's lots of other things that have been changing around with mortgages. And one of them, of course, is sort of product fees. So I know in the past I've had mortgages that have had no fees. I've had ones that have cost, I don't know, £1,000-ish, £2,000-ish. I haven't really, well, I have seen, but I haven't chosen any that have had percentage-based fees. But I seem to be seeing those sort of mentioned and listed a lot more. So what sort of fee options are there on the market at the moment, and how has that changed in the last few weeks?
I don't think this sort of change in rate or view, longer term view by lenders has made a particular change to fees as such. We have started to see percentage fees come in for lenders, and depending on where you are, it depends on loan size, clearly, as to how attractive they are. Percentage fees, certainly in the investment side, the buy-to-let market, HMO market, etc., were quite popular probably 10, 12 years ago. They were pretty much across the board. It was a percentage fee. That then stopped when rates went, or not stopped completely, but generally, again, a lot of this is general, of course, but then went to a flat fee. So you're finding you were paying for a residential mortgage, 995 was fairly average. And then for buy-to-lets, HMOs, it was 14,995, or depending on, or 1995, which was a popular fee to be had. It does seem to have, they've started to move across, and a lot of the lenders are going to 1%, 1.5%, 2%. I can see it's more coincidence rather than a kickstart because of the rates and the service. Maybe the service issue has had something to do with it, because it certainly coincided with the two. I don't think the rates has particularly driven that.
Do you think, or are you seeing any benefit? Because obviously from our side, the reduction of products is, for me personally, quite a challenge because of the different properties that I own, HMOs, buy-to-lets, some 6 beds, some 2 beds. So then when I see such a reduction in products, because I think we noted that, I don't know, it dropped by almost 25% in terms of number of products available. It's gone quite rapidly from like 1,600 down to closer to 1,000. These are rough numbers. But then the other side of me says, hopefully that means that the banks can be a little bit more focused about what they do. So maybe it is a good thing for everyone long term, both from a service perspective and from a just being very focused about what they are offering to the market. Are you seeing anything sort of anecdotally that supports that is helping? Because I'm not going to get into Kent Reliance. I've done a few feedback forms recently, so we don't have to go into that. But are you seeing any sort of improvements because of that? Are you seeing benefits to the reduction of products?
Interesting to benefit from the reduction? No, is the simple answer. Absolutely not. I think the lending and criteria is becoming more and more difficult. You try and read between the lines and see what's happening. I think lenders are nervous. I think they're nervous short term, medium term, meaning a year, 2 years, 3 years in the mortgage world. I think they're definitely nervous and not quite sure. So they want to look at the safe, secure lending, the very vanilla style type lending out there. So they're not very aggressive. I don't think you'll see sort of the more sort of aggressive, quirky products, which were fortunately coming back into the market, where lenders were saying, right, okay, what can we lend on? Where is there, a gap in the market we can look at, which is quite, it's good for us and it's quite exciting then. Now it seems to be that sort of, again, knee-jerk reaction, I feel, about coming right back. Okay, we've had experiences, Stuart, recently with just ridiculous comments coming out from lenders. And of course, you haven't got anything to go back with them. You can't argue it. It's in their criteria. If they agree to lend, they agree to lend. If they don't, they don't. It's as simple as that. They're the ones who are in control.
Yeah, they're an immovable object, and we have talked about that on our podcast, so I don't have to go down that ranty rabbit hole today, fortunately for me. Yeah.
Absolutely. No, I think certainly for us as in the broker market, you and as investors and business owners, I think it's going to be, nothing happens very quickly. I'm getting asked this a lot over the last 3 weeks of rates changing dramatically. I, myself, the team, people I speak to, we were all getting the same questions. What's going to happen? Where are rates going to go? What do you think is going to happen? Same sort of question, Stuart. What do you think is going to happen with products? Nothing happens very quickly. They'll withdraw these products. They won't come back on the market. I would put my hat out there to say they're not going to come back on the market with some really good, innovative products for a while yet. And a while, I mean, that's a general term, very grey, but I mean a year or so. It would be my suggestion before to let everything calm down. Let's see what happens, see what this recession brings, how long it lasts us for. And then, like any business, they may come back in the market slowly and stuff. But I think for mortgage products wise, I think we're possibly in for a tough time with anything quirky, let's say, for the short term.
Well, I think that leads us nicely into talking on about mortgage rates. But before we get into that specifically, just again, I work with a couple of clients where I'm supporting them basically as a property consultant and helping them invest. And I've got one guy that can no longer invest in the properties that he was going to invest in because of the interest rates. What did work now won't work. It's both the interest rate combined with the utility price increase. So we've got something that might have worked at 3.5% as an interest rate, but cannot work at 6.5%. So that. And I've got one guy who's buying in cash. But the interesting thing I was going to say about obviously waiting for products is that I had this conversation yesterday when we viewed 4 investment properties, and the person buying in cash said, "Yeah, I'll just wait a couple of years before the rates come down," and that sparked a conversation which from my side was, we don't know if that's going to happen. And we'll talk about that with the rates. And so then that just sparks a really good conversation about, okay, so actually what we do need to do is stress test kind of our investments at 6.5%. And Simon P would come straight in and say, at a minimum, I'm sure, that's it. So I thought that was just an interesting point about, because I know the question you get is a question I get a lot is, what should we do? How long should we wait? And of course, none of us can answer that question because none of us have that crystal ball. What were your thoughts on that, Simon P?
Yes. I mean, stress testing at 6% or so. I mean, that's far too little, I think, these days. And indeed, I think the mortgage companies agree. We've got a couple of other things we want to try and talk about at some point, but let's go on to starting to talk about rates. And let's start with the stress tests for rates, because they have gone up a lot, even more than the actual sort of basic rate, which you'd expect, because the stress rate should be higher than what you can actually achieve. So what sort of stress tests are now being applied to mortgages?
That's an interesting one, really. And you're absolutely right. They've changed dramatically in a very short space of time. So, for example, I have one here, which this is a leading buy-to-let lender. Also lend to limited companies. Well, not one of your favourites, Stuart. You'll be glad to know.
Thank you for I'm thinking of a simpler word than obfuscacy. I don't even know if that's a word, but thank you for obfuscating that company. Yeah, and that's a tough one to get your tongue around.
I'm not going to try
on a Wednesday.
Absolutely, I'm not going to try and say that one. But they are now stress testing at 8.49%.
Lord above.
Absolutely. So, and a quick to give you an idea of how this affects the market. So, you're buying a standard buy-to-let. well, you probably wouldn't be after this, £200,000. I'm guessing a £200,000 property is probably going to generate about £900 a month rental, as a guess. This is all very average and possible. That will basically get you 50% loan to value. Now,
ouch.
So they will, yeah, absolutely. Even on a 5-year product, because they would lend more on a 5-year product. Now they're saying so, and if that goes up, so let's just be generous and say, okay, well actually it'll get £1,000. Okay, that will get you. It will go from £100,000 to £110,000 that you can borrow. Makes hardly any difference.
I'm looking at Simon's face and I'm seeing deep concern because he's looking at. I mean, so am I. But Simon's gone white. So.
Whiter, absolutely.
It's just crazy. This is presumably at a 145%.
It is at. Let me just check on there. 145. Yeah, they're using at 8.49% is their stress test.
Wow.
Now that is one of the leading largest lenders in the country. So from that, I mean, they're notoriously they are quite strict, but you see from that, all the other lenders will follow, or pretty much so. It happens. It always does. So expect that pretty much across the board, very, very soon. But, where there's, like you said, Stuart, it's a case of, right, we're going to have to build this in. This is where we are. We can't hide behind it.
Exactly.
There isn't any other way. I'm getting calls daily, numerous calls daily. Well, what about, I can't afford that. That's not, expecting I can pull a rabbit out of the hat. It isn't, I don't have that control, unfortunately. I'd love to. That'd be very good. But they're the products.
And you look nothing like Paul Daniels. Just for the listeners' sake, I can just confirm he looks nothing like Paul Daniels.
I have Debbie McGee coming through with my coffee in a second.
But that is the point, and I think Simon and I mentioned this on previous week's podcast. Is that is exactly what we've got to do when we're reviewing our potential investments now, the deal analyzers. So you've just said it there. Basically, 8.5% is what you got to kind of look at. And if someone says that doesn't work, well, guess what? It don't work. So you got to move on and think about the model. And if 50% loan to value scares the living daylights out of me, because as you know, if I look at my portfolio as an average, it's probably still hovering at around 80. So that's the world I live in.
Yep.
But like you say, we've got to operate if we want to continue, and some people won't. But if we want to continue, we've got to recalibrate to those metrics, haven't we? So it's as simple as that.
Absolutely, and you're not alone. That's it. People who have started a portfolio over the last, let's say, 10 years, or within that period, are generally speaking, they're going to be hovering around that sort of loan to value, because you're borrowing money at a very cheap rate. So you're getting 80, 75, 80, 85% LTV on wherever you can to gear up as much as you can, go on to the next project, and it carries on. So there are an awful lot of people out there doing exactly the same thing, and that is the business plan. Nothing wrong with it. You've just got to rethink how it works going forward, which then goes on to, well, will that then have a reflection and a correction in house prices and or the particular house prices investors are looking at? Certainly with not necessarily standard 1-bedroom, 2-bedroom buy-to-lets, because they can be sold to the open market as a residential, but more specialist products, multi-unit blocks, HMOs, that sort of thing. There may well be a correction in the market there, because if the vendor is then not getting the footfall through the property and the offers in, well, naturally what you do is you reduce the price, unless if either you decide to sell or want to sell, whatever the need is.
We don't go too deep into this today, but I'm just going to support what you're saying, because I am looking for those properties, HMO properties right now, and have been for quite a few months this year, and I'm seeing that play through. And I don't want to get into are we heading for a crash? Because I'm not sure I like the word crash anyway, or correction's probably better, or whatever words we want to use. But I am seeing that what you're talking about is exactly what I'm seeing, particularly in my area now, and in all areas may happen at different times. But prices that people were, I went to view 2 properties yesterday, and by my own estimation, the vendor is overvaluing it by 50%. And I spoke to the agent outside the house because there was a couple of us there, and the owner was there, and the owner went in, and I turned around to the guy and I said, "This is basically it's probably 50k more than we'd expect to pay for this property." It was a dilapidated, it wasn't very nice. It was really horrible. And the agent agreed, and he said the challenge that they've got is that some vendors haven't yet caught up with the things that you're talking about. They may well do when their fixed periods end or when their terms, they'll suddenly realise what those of us who are out there looking at the market are facing, because right now they might still be on the 3.5%, the 4%, or the wonderful days I was in of the 4.79s. They look wonderful now. That was high at the time. So I do think that's going to happen, particularly depending on the tenant profile. Student properties, if they haven't filled, they're going to be coming onto the market now. Obviously, working professional properties, that's going to happen. But I think that's what we'll see, those properties stick on the market and those values start to come down. And it's just how quickly that happens, I think. So just wanted to support what you're saying, really, because I'm seeing that in person.
I think that's it. It's a good point, actually. But that hasn't changed. Over the years, we've seen that on the broker side forever and a day, certainly the years I've seen, because unfortunately vendors will get told one figure, usually by an estate agent who wants to get them on the books. So ramp up the asking price. I'll get that for you. Absolutely no chance in the world they will. But of course, it's natural. You're then told your property, which, just throwing figures, is realistically worth 200k. And some agents say, "Don't worry, I've got loads of people interested in the area. They're crying out. They're coming with a cash offer of 250 tomorrow." In their, subconsciously, they have that 250 figure in their mind. They've already spent that money. So trying to get them back down, that's obviously a huge difference, but it works in whatever figures you want to throw at them. But as soon as you have the higher figure, every single person I've ever come across always works on, it was up at one point 3 years ago at 250. So you think, well, yeah, but you never had an offer and you never had anybody through the door. But subconsciously, again, they're constantly thinking it's worth 250 because one person has told them. It's just natural. So, but like you say, vendors will take time before they think, right, okay, I've got to reduce. The market is out there. The sensible ones won't. There'll always be some thinking, right, there's no way I'm going to sell this at that rate. They'll know the market. They'll know the stress testing. They'll know their market, the people are going to come around and buy and visit and make offers. So they're going to have to reduce. Others, I think you'll just see sitting on the market for a lot longer than you would have done previously.
At the other end of the process, there's another point of valuation. So past the agent, past the vendor, past the buyer. If you've got a mortgage involved, there's a surveyor and a mortgage company doing another valuation. How are you seeing those? Have you seen a big change in what is happening with those in the last few weeks, given everything that's happened? And whether or not you have, just how are they going generally at the moment?
Generally speaking, I would say, apart from one case where I've had a portfolio landlord and a number of their properties have been upvalued, which I've not seen for an awful long time. And I think just mismanagement of figures there more than anything, but it did make me smile. But generally speaking, we're seeing valuers down value by quite large figures. Had one this week, an HMO in South London gone from 1.6 down to 1.1, which was really shocking, especially where it is. It's not a particularly grand property, but just for location and size, we're just completely speechless. But generally speaking, yeah, down valuations are rife. Valuers, I think, don't want to be left being blamed for it from the lender point of view. Whether they're being instructed by lenders, by the powers that be, who knows? We go through this cycle. There's always every, I don't know, 5 years or so, we have this period of, right, okay, they call it corrections, we're just calling it down valuations. And we go through, and we're going through it at the moment. And again, it's okay, if you know and you're in the market, you kind of appreciate it and you go, right, okay, well, this is where we are at the moment. I may get that uplift again when I look to revalue it in 2 years. It's one of those things, again, we've just, unfortunately, we kind of got to live with. The appeals process for all of these things is horrendous. I think everybody would agree. You send in an appeal, you do an awful lot of work getting comparables and get just to be told that the valuer then, no, doesn't agree with you and will stick with the original valuation.
Yeah, it's very frustrating, and we've talked about that, yeah, quite personally and on the podcast. So I think it's probably time we move on to the rates then, Simon, in terms of where we're currently at. So maybe if you give us a quick run through, and we can just have a talk about the rates.
Yeah, generally, an interesting point at the moment. The 2-year rates are, on the whole, certainly on the residential market, higher than the 5-year fixed rate. So that may give you some sort of indication. With a remortgage or a home mover 2-year rate, to give you an example, at 75% LTV, you're looking at about 5.7% now. And again, these change, guys, remember, and all the listeners out there, by the time this goes out, this could then completely be out of date and change because they are literally changing daily and we don't know what's happening.
Yeah, and I think what we also say is right now what we're talking about is indicative. We're not putting guidance out there. We're not telling people to choose products. We're just commenting on where we're currently at and what's going on. Obviously, for anyone listening, please do just check with your own broker or with your specialists about what's currently available.
Or, of course, get in touch with Simon and ask him.
Absolutely, yeah.
Absolutely. And that's the thing. These things do change. Whereas, as brokers, we're always happy to sit down and talk to people whenever they want to. But this is just to give you people an idea of what's out there, what's around. 5-year rates, you're looking at around about, this is residential again, just over the 5% mark, 5.09. There are a couple of little quirky types of rates out there, which you may be able to reduce slightly. And again, they're more specialist and if they suit your needs at any one time. Going on to the investment side, onto the sort of limited company buy-to-lets, you're looking now, 5-year rates are just over the 6% mark for 5-year fixed rates. 2-year fixed rates, not really sure, where, if that's what you're thinking, just over 5%, 5.09. Something to consider, which I'm talking to a lot of people about at the moment, tracker rate. Tracker rates on a limited company buy-to-let, 3.54. That's a pay rate. Now, you have to start thinking, well, how much are rates, how much more is the base rate going to go up? We don't know. Clearly, none of us know. None of us got that amazing crystal ball we all want. But it's got to be a consideration. If you can look, and certainly I'm talking to a lot of people, if you can get something without a tracker rate, maybe a 2-year tracker rate so you're not tied in too long, or a tracker rate which doesn't have any redemption penalties, so you can switch over to a fixed rate at a later date. It's got to be a consideration. Tracker rates have just been unheard of in the last 10 years, for obvious reasons. But at the moment, it's got to be a consideration. I mean, going back to residential, you can get a tracker rate 2.74 as a pay rate. Now that then that's a little bit more attractive, and again it gives you an idea of what's out there. And again, HMO multi-unit blocks, very very similar to the limited company buy-to-lets, a tad higher, about 0.25% higher. So that will give you an idea of what's happening in the rate market at the moment. And just going back to when we were having a conversation together a few weeks ago, that's about 1.5% higher than what we were discussing literally a few weeks ago.
That's quite a scary speed of change, isn't it? It's yeah.
Well, I was looking at this versus about 20 years ago, basically. So if I think about those rates that you've just gone, so most of them started with a 5.7 resi 2-year fix, 5.09, so or 6% for the 5-year. when you go back 20 years, and this is just, for me, just gives you a little bit of context, 20 years, and this is average interest rates for mortgages. So it's not for a specific type, but average interest rates for mortgages, 2-year fixed 6.45 20 years ago. For a 3-year fixed, 6.7, and for a 5-year, 6.94 for the 5 years. So that's pushing, that was pushing 7%. And then I had a quick look at basically just after the financial crash, but it didn't get that high. It was 6.6 on a 2-year, 6.39 for a 3-year, and 6.4. So again, above 60. So my head says that's very easily it could go back to that point, and we've been there because that's not so long ago, and actually 20 years ago. So when you look at where we're at now, that's not. It is to us personally, but it's not a huge increase in terms of just one or two more rises. I mean, one more 0.5% increase and we're there, or 1/4% increase and we're there on some of them. So it just shows you what could happen.
Yeah, I agree. I think we just get very comfortable. I think we've got very comfortable as a society, haven't we? Business owners, brokers, we of just constantly talking about very, very low rates because they've been around for such a long time. And now it's the shock, I think, of them increasing so quickly. I think that's the key here. We're not quite used to it. A gradual, less painful rise would have been easier to take. But again, I'll go back. We are where we are. These are the rates. I agree, Stuart. I think there will be another. The feeling is there will be another rise. It's likely to be 0.5% from the talk of the town. So those rates are going to go back up. With 6% rates are going to be commonplace. We need to build that in, or buyers, investors need to build that into their calculations going forward. How long it's going to be before they come down, and the other thing is, if they do come down. It's a big if, but if they do come down, what are they going to come down to? Personally, I don't believe they're going to go back to where we were because they were ridiculously low.
Yeah.
Everybody knew that. Everybody knew we're sitting there on rates of sub 1% for their residential property. Knew they were, they were unheard of, and it can't possibly stay where they are. Now it has moved up. That's kind of where we possibly should be. A little bit higher than possibly where we should be, but that's again personal.
And that's why I was looking at the older rates, the average rates, because we have been, and myself included, we've been anchored to these low rates, and therefore inherently we feel like we can go back to those rates. But actually, when I look back, because we've been used to it for the last 10 years, in our minds, that's the truth. But actually, 10 years ago, they weren't that. 20 years ago, they weren't that. So actually, it could just be, as you say, they might go down to something, but it might be 5%. That might be the new low. So as you say, I think for all of us as investors, we've just got to reframe what we do and work with those new parameters.
Absolutely. I think that, and we will do over time. It's just a case of getting used to it, isn't it? I mean, it's a shock for everybody. It's a worry for everybody. I think people have got used to it. People's spending has been in comparative to what they've been paying out on their mortgage, so they've been spending more. But with the cost of utilities going up as well, I think people are already used to saying, right, we're going to have to cut back. They will cut back more because their mortgage rate's going up. We've got to remember that an awful lot of those people are still in the middle start, getting closer to the end of a fixed rate. So it will not affect people immediately, a lot of people immediately. But certainly for me, over the coming year, 2 year, 3 year period, that's when the shock's going to happen. All of these people falling out, so they've stretched themselves to the limit at rates of 1.5%, it's going to be a real shock when in a year's time, 2 years' time, when they can no longer afford the new car on the drive, and things like that and luxuries like that will have to take a back step.
Sort of related to that, something I was wondering about asking earlier actually was where the stress tests are getting much harder. How are mortgage companies currently handling that for remortgages? do they, and I suspect this is different whether you're remortgaging with the same lender or whether you're trying to remortgage away, are there any is there any leniency on those stress tests?
Yeah, there are a few lenders who are looking, if it's like for like, now a like for like investment buy-to-let property, and you're not raising any more money, they are a lot more lenient. There are a couple of products out there to say, right, okay, that's what you're doing. You're not doing anything different. You've obviously been paying, and that to me is common sense lending. You're not doing anything different. You're not raising more money for whatever reason. You just want to improve the rate. Well, it won't actually be improving the rate, but you want to get a most competitive rate. So yes, there are a few of those. We get the feeling that they will be more commonplace. Raising funds from investment properties, unless you have a very low loan to value, is probably not going to be as common, but certainly switching from lender to lender, because what we are seeing is rate switch / product transfer rates are very high. That's certainly something. So people will be looking to change lender. And if they have this product where they will just literally switch it over without too many questions asked, that will be, that's a really good move forward.
And final question, because I appreciate we're running over a usual allotted time, but are you seeing any changes with regards to ERCs being added to products, or is that something that tends to stay fairly static within the product offering, if you know what I mean? So it's usually we do one with ERCs, which is a slightly lower rate, and one without our ERCs, which is a slightly higher rate, or with a product fee. Are ERCs something that are fairly static in products, or is that not?
Yeah, absolutely. Not a lot has changed. I mean, you get the odd one here or there that may come out. They were testing the water. I believe some of the lenders were testing the water just to have a ERC-free product. There were a couple out there. They were quite attractive, actually, to be fair, and more so on the tracker rates. You will find them on tracker rates, which are, and I think my feeling is you'll find more of them out there. They will. That's the type of product which will come back in the market to get the good quality business in, which does make sense from a lender business point of view. Get some good quality business in on a tracker rate, so they're making their profit because that's what they're geared for. The client is happy because they're getting a good, decent tracker rate, and it's lower than and they're free to move to wherever they may want to go and switch on to a fixed rate at a later date. But generally, going back to what you said, Stuart, they've pretty much stayed stagnant. We haven't really seen any sort of dramatic for a number of years now.
Fine. And I should just say, because I did the thing which I hate doing, I used an acronym without actually saying the whole thing, which was we're talking about, of course, early redemption charges. So I just thought I'd say that because I just used the acronym.
Right. Well, on those two pieces of good news, that stress testing is not being increased too much on remortgages, and ERCs are not really changing very much. I think that's about as good as we can get in the mortgage market at the moment. So we're going to finish there. We have also run over time, so we definitely need to finish. So thank you very much to Simon Glastonbury for joining us. If you'd like to get in touch with him, contact details will be in the show notes. And hopefully the mortgage market will now stay nice and stable for a little while. And we will invite Simon back again in a while. And hopefully it'll just be a nice, gentle update and saying that things are moving along swimmingly. But
we're all shaking our heads.
We shall see. In the meantime, anyone listening, if you've got questions you'd like us to put to Simon next time he is on, or any comments on what we've said today, please do get in touch. You can reach us on @BIZ of Property on Twitter, or you can contact us via thebusinessofproperty.com, which is also where you can find all of our show notes and past episodes. And we will talk to you again next week.